Welcome to the AWA Market Minute, breaking down financial, political, and economic events that impact today's retirees. Our investment committee performs hours of research and market analysis every month so that we can share simple summaries with our clients in 30 minutes or less. Featuring top industry experts who share insights on important topics so that our clients can gain understanding and peace of mind on their journey to and through retirement. And now your hosts, Chief Investment Officer Scott Hoxer and Founder and CEO Paul Coles.
Well, welcome everyone to another episode of the AWA Market Minute. Scott, how are you?
Doing great, Paul. Yeah, we had snow flying yesterday for about the first time this winter. We haven't had much of a winter here in Utah.
That is true. We finally got to shovel our driveway last night, and it's literally been a year plus since we've had to do that. And I hadn't really prepared the snowblower, so I was out there with a shovel, and then we drove over it a couple of times before I got to it. So I used an actual garden shovel to break up some ice. So welcome winter. A little late, but you're here.
Right, that's right. Yep.
Well, very cool, Scott. We get a lot of conversations about precious metals and their role in kind of modern portfolios, and they've occupied the front page quite a bit lately. We've seen historic rallies, sharp pullbacks. There was a steep drop after the announcement of Kevin Warsh as the Fed chair nominee. So I thought maybe this market minute we could dive into the conversation on the role of metals in modern portfolio theories. And specifically, we got some a lot of retiree clients, and they get these questions regularly. And so let's start kind of broad and talk about where they belong and where they don't belong. So Scott, what's happened in the metals market over the last 12 months that has pushed this topic kind of to the front page and top of mind?
Yeah, no, great question, Paul. And there's been so much going on in this space that I think this is a great topic to delve into today. One, it's occupied front page news because all-time highs after all-time highs in a variety of metals continue to be set. And so that obviously occupies front page news. And I think we've seen a real pivot, if you will, to metals in particular as a perceived safe haven. We'll talk about a little later about how safe these metals actually are. But I think with high levels of national debt, with currency debasement, with trade wars, with geopolitical conflict, the whole 9 yards, I think there's a broad perception that metals are a safe place to kind of flee to. And I think that's helped drive a lot of that demand. And there's also been no shortage of ink spilled and advertisements made in this space. And so I think we can hopefully unpack some of that today.
I love that. I think that there's intrinsic value there to metals. And I think that kind of people lean into that during moments of market uncertainty or economic uncertainty. And people say, well, shouldn't I have some gold or some silver or something in there that kind of adds value beyond just ones and zeros, so to speak. And I totally understand and appreciate that. But then we also see a lot of that ad space that is like, hey, this half hour is sponsored by a particular, ad agency that's selling something. And so people often have a hard time differentiating between, when is it actually the appropriate positioning in my portfolio versus when am I being sold, a product that I'm being marketed to. So a few weeks back, Scott, we saw a sharp drop following that Warsh nomination news. So what does the reaction tell us about how markets are thinking about metals today?
Yeah, no, excellent question. So the talk for the past several months is, who is President Trump's Fed chair nominee going to be? Is it going to be someone who's very dovish, or someone who's very accommodative with rate policy, or someone who's more hawkish and is going to be more stern on keeping interest rates relatively high? And Kevin Warsh was widely perceived as one of the more hawkish of that potential short list of nominees. And so the market reacted to that by unwinding some of the trades that had been placed on over the past several months. Markets had anticipated someone super dovish. They got someone maybe a little bit more hawkish. And so they responded pretty viscerally And this is a great example, Paul, of what, is termed markets sell first and ask questions later.
Yeah. Yeah.
And so there's usually an overreaction to new news, and then there's kind of a recalibration on the back of that. And that is indeed what we saw. There was a huge sell-off, particularly in silver. In a single day, it fell about 30%. But a lot of those metals have seen increases in prices since then. But there has been a definite reaction to what we've been seeing with the Fed chair announcement.
So this is the slide that you just referenced, Scott. How silver was impacted. We saw that one day drop, like you said, nearly 30%, and a response to the way the market viewed the Warsh nomination. Obviously, the inverse of this is we saw the dollar surge as metals fell.
Yes.
So just kind of how people view that relationship. And to your point, markets like to ask questions after the fact, right? It's like respond quickly, ask questions later. And we saw that. So is this just typical volatility? Or is it a potential red flag in kind of metals?
I think the short answer is yes. I think it's a little bit of all of that, Paul. I think silver in particular, I heard a colleague refer to silver as the devil's metal. And it's called the devil's metal because it has high levels of volatility. And I think it's almost healthy for the investing public, many of whom are new to kind of the metal space, to see how truly volatile they can be. And silver in particular has more volatility than gold and other instruments. So I think it is a combination of there's probably a visceral overreaction, but I think also a cautionary note that metals don't just move in one direction. They can move down, and they don't just uniformly move up in value. They can have volatility just like any other asset class.
I love that, and I think of this a lot like, real estate, even where people don't always have the day-to-day pricing on real estate. And so there's maybe a general kind of misnomer that real estate doesn't have volatility, because when you look at something over periods of like a 2-year stretch, it's hard to know all that short-term movement that took place in the market between those 2 points. And oftentimes people will hold silver, they'll hold gold, and they don't look at the volatility in the interim. And so they see stocks and they go, well, look at the volatility. And it's like, well, if there were a way to measure that volatility in real estate day by day, you'd probably be a little more aware of it. And when we look at silver or gold in an actual, marketplace where you can see the volatility and you can see the movement, I think it's a good exercise to be mindful of the reality that silver and gold can, in fact, do, change prices regularly. So Scott, walk us through this chart here.
Yeah, so what this illustrates is the spectacular rise we've seen in a variety of metals prices over the past 12 months, and it's been just stunning, Paul, to see what we've seen in the metal space. You can see silver up almost 154%, gold up 65%, steel up 55%, and then rare earths generally up about 100%. So I think as we look at these, I think it's good to kind of delineate the difference between the different types of metals. I think they sometimes get grouped into a single category, and they're very dissimilar. I think sometimes people have the notion of, hey, I can put my money kind of safely in metals, and they're a tangible asset, and they actually behave very, very differently depending on kind of the nature of the metal. And I like to think, Paul, of metals in kind of 3 different buckets. One is kind of the industrial use bucket. That's going to be things like steel and commodities. And those are, or steel and copper, they are commodities at the end of the day is what those are. And they are industrial inputs, and no one is putting a bunch of steel or copper in their safe as a hedge against, apocalyptic scenarios. They have a very specific use, and it's driven by supply and demand. The next one is kind of what I would term dual use metals. And this would be things like silver and gold, where historically they have been used as as a form of currency and as a medium of exchange. but there's also use. Gold is used in electronics, it's used in jewelry, it's used in a variety of applications. Silver, the same thing. So that's kind of that dual use category.
Yeah.
And the last one is rare earth metals. So this is stuff like scandium, and these are hard to get resources. It's not that there's not an abundance of them, but typically they're really hard to get to, and they're not found in concentrated amounts. And that's why they're called rare earth items. And these have become increasingly important because they're used in military applications, in electronics, in kind of the green revolution for solar and batteries and everything else. And so those rare earths have been very much in demand as well. But the bottom line here is, regardless of what bucket the particular metal falls in, the past 12 months have been an outstanding spot, or had seen outstanding performance.
Yeah. So let me unpack that a little bit further. So I think it's a great point. Not all investors understand that not all metals will behave the same. We can't just lump all precious metals in the same category and say they all behave the same. There's actually diverse utilizations and performances of each of those metals. I love how you've framed that out, Scott, where you break them into different kind of mental buckets and say, okay, this is what that bucket is for. Let's talk specifically about those industrial metals. What might drive the value or the performance of an industrial metal?
Yeah, so a couple different things, and at the end of the day, it's basic supply and demand. But when we have robust economic growth and economic expansion, the demand for those go up significantly. And so, generally speaking, a rising tide via GDP growth across the globe, that's going to be a driver of price there. The other piece is just an availability piece. To the extent there's anything that disrupts or constrains how much supply of these metals is available to the market, that can also be a big input. But these aren't dissimilar from a lot of other commodities, be it fuel and petroleum and lumber and other commodity type inputs. I think the right mental construct to use for those is to think about these just like you would any other type of commodity.
Perfect. So, and then we talk about the dual use metals, gold and silver. Are there significant differentiations between gold and silver? You referenced silver. A colleague said something about it being the devil's metal. Do we see that similar kind of comparison to gold, or do you feel like those have kind of significant differences?
I think there's some pretty material differences there. I think throughout history and in modern times as well, gold is perceived more as a store of value vis-a-vis silver, and so we see that, and we see that where central banks have been buying gold en masse. I've looked at some data where the most recent 5 years versus the previous 5 years to that, central banks have doubled their gold purchases. And so central banks throughout the world do perceive this as a bona fide store of value, whereas silver, has a degree of that, but not to the same degree that gold does.
Okay. And we talked about rare earth metals and some of the strategic importance of those metals in actual products and applications that we need, electric vehicles and batteries. So if someone asks you, I want exposure to metals, what would be kind of a clarifying question you might ask?
Yeah. So the first question is why? Why are you wanting exposure? And then I think based on the response to that the metals in the portfolio can be tailored accordingly. If the response is, I want metals in my portfolio because I'm scared what's happening with the U.S. dollar, with the national debt, with global unrest. Based on that answer, that might be a focus around, gold and those types of metals. If it's more, hey, I think there's a strong thesis that these rare earth metals are going to ever increase in demand. And right now we're seeing a race among China, the U.S., and other large companies to get as much of these out of the earth as possible. And based on that thesis, I want to capitalize on that. Yeah. That would lead to some positioning. Or if I think, hey, the economy is going to grow significantly, and I think the demand for copper, steel, et cetera, is going to go through the roof, we would make some adjustments. And it might be a blend or a combination of those, but the why really dictates what exposure the individual gets.
In other words, sometimes investors might have a purpose for owning something and not understand that buying one type of metal doesn't mean it behaves and acts like another type of metal. And so we need to unpack that further. You don't want to purchase a rare earth metal with the idea that you're getting some kind of intrinsic store of value, some kind of apocalyptic insurance for a potential market crash. So it's important to kind of know the differences. I like that. So Scott, let's talk a little bit about why metals are so popular today. There's clearly a deep interest. There's ads everywhere. There's ETFs that track these metals up everywhere. And let's maybe talk a little about what's driving that demand. What are the primary drivers maybe behind metals popularity today?
Yeah, I think it's I think there are several, and I alluded to a couple of these earlier. So one is a distrust in kind of the global financial system to a degree that we haven't seen in a long time. National debt levels across all developed countries are at record levels, and there's concerns that currencies could fall in value, that the US dollar, the euro, the yen, these could not have the same value potentially in the future that they have at present. And so I think investors are looking for something that is going to have a high level of value relative to those depreciating currencies. And so I think that's one piece. I think the other piece is we're seeing a big shift throughout the globe as it pertains to the US dollar. So there's two factors putting a lot of pressure on the US dollar right now. One is a lot of other countries throughout the world want to see the US dollar replaced as the world's reserve currency and are making concerted efforts to try and make that happen. The other piece is through trade policy and also through the articulated policy of the administration. They've indicated they'd like to see a weaker dollar for trade purposes. And so when you have external forces pushing down on the US dollar, internal forces pushing down, and then a debt burden that's pretty significant, I think all of those factors, play a role. And then the other thing I think has been driving the price appreciation has been kind of what I'll term crowd behavior. People are piling on, and this is how bubbles are formed, and this is how momentum, kind of gets built. Is everyone has to have it, and there's certainly a degree of that. And so it's a little bit difficult to untangle right now how much of the appreciation in gold is just speculation and kind of crowd behavior, and then how much is grounded in actual fundamentals. And there's a degree of both. The demand for gold unquestionably has continued to rise, and so there is a fundamental factor there. But there's also the mania of crowds, and we're seeing a degree of that as well.
Yeah, and there's probably like a psychological component as well, like the appeal of owning something tangible. For a lot of people we talk to, they do like feeling that, right? They say like owning a share of McDonald's is not tangible. It's hard to know if I have any real value there, but if I have gold in my hand or a rare earth or something, that I feel like that is tangible. So I think there's psychological intrigue there. Let's talk about maybe, and you kind of keyed on this a little bit, but the inflation hedge thesis. Do you feel like that's one of the other core drivers to gold or any precious metal, is the idea that we can get an inflation hedge against that? With that, I should say.
Absolutely. And I'm glad you mentioned that, Paul, because that is a key idea that people have kind of grounded in their mind, that gold, silver, other metals, they protect me against inflation. And that's true until it's not. We see periods of time where that is true. We see other periods of time where that's not true. In 2022, for example, gold was relatively flat. Investors in gold didn't really lose money. They didn't really make any money to speak of. Inflation at that point in time was at about 10%. And so your gold at that point in time was not keeping pace with inflation. Conversely, if we look at kind of the late 70s, gold moved up markedly in value as inflation was high. And so that was a period of time where the inflation hedge was in place. But it's not a immutable law that gold will keep pace with inflation, because we can point to periods of time where that hasn't been the case.
Yeah, so I think sometimes the inflation hedge narrative might be oversimplified, because I think it doesn't always work the way that sometimes that narrative is spun, that it's always going to be an inflation hedge. And I think there's been many periods of time we can point to throughout, the economy and markets where we've said, actually, it doesn't quite work the way that you would have thought it worked in those moments. And so what can we maybe learn from that? What's a good takeaway from that?
I think a good takeaway from that is gold and these metals, they're neither good nor bad. They're not kind of the end all be all, nor are they something to be disregarded entirely. We actually think that metals generally have places in a portfolio, albeit in not large quantities. And the reason why we like having some of that in a portfolio is typically metals are what we call non-correlated assets. And what we mean by non-correlated assets is they don't move in lockstep with markets. And so if the S&P 500 or if the Russell 1000 or the Russell 2000 move in one direction, gold and silver and these others that we've talked about won't always move in the same direction. And by having some assets in your portfolio that are good assets, but aren't 100% correlated to what everything else in the portfolio is doing, that can give you some added diversification. And maybe when the market's zagging and you want to zig, having some metal exposure in your portfolio enables you to do that.
No, I love that. I think that's actually a really good place to segue into kind of the correlation concept of portfolio construction. Maybe before I do that, just one final point on what kind of driving the fundamentals of, or rather kind of the precious metal conversation. I think it's important just to, whenever we talk to people about, the retirement portfolios, making sure the fundamentals of portfolio analysis and asset allocation and selection is what drives the demand for that and not fear, right? Because I think one of the concerns that I have is when people get that fear-based, concern and they say, I want to buy this because I'm scared of something. And that's generally not going to result in a positive, long-term investment decision. We want to be very fundamental, very intentional about why we build something. So in that vein, when we talk about portfolio construction, why does correlation matter so much in whole? Zoom out a little bit, just outside of even precious metals. Why does correlation matter in portfolio construction?
Yeah, so this is a topic that academics and others have kind of bandied about for years, and it has its roots kind of going back into the 1950s, where academics at that time were able to do some research and find that if certain assets were paired together, you could get strong long-term returns without as much volatility. And so what they found early on is by pairing assets that don't do exactly the same thing together, you smooth things out over time, and the amount of return you get relative to how much risk you're taking actually ends up being a little bit higher. And so that was kind of the genesis of that. And over time, that's been refined and has become more complex. But the idea is to have enough variety in your portfolio where not everything goes up at the same pace or at the same rate, but also not have everything go down at the same pace and same rate. There's an adage in portfolio construction that says, if everything in your portfolio is going up at the same time, you have done something wrong. Yeah. You may pat yourself on the back and say, hey, good on me, I've done great, and everything's going up. The flip side of that is when everything goes down, you will likely have a significant drop. And so we don't mind if we have 20 holdings in a portfolio and 16 of those are knocking out of the park and 4 are struggling. We're okay with that because we know that at some point a flip will occur. And when that does, those 4 that are struggling will probably have their day in the sun.
So we'll zoom in here in a minute and talk about specifically, precious metals and correlation, but like to further kind of explain this concept over the last 10 years, stocks and bonds, kind of walk us through what we saw there when it comes to a correlation conversation.
Yeah, so this is a great kind of case study. So historically speaking, the idea is, when stocks fall, bonds go up and vice versa. And over the past 10 years, that hasn't necessarily been the case. If we look at 2022, for example, stocks fell significantly and bonds fell significantly. So that historical relationship broke down a little bit. We had a combination of a correction in stocks and interest rates going through the roof, which pushed the value of bonds down. And so those correlations were very closely related in 2022. So that protection that one had historically had by a stock and bond portfolio didn't hold in a year like 2022.
So this, I think, is a chart that references, kind of that concept, right, of the correlation here. Walk us through what we're looking at here.
Yeah. So what this shows is this is a kind of simple correlation chart, but we're looking at two assets. We're looking at stocks as measured by the S&P 500, and then we're looking at bonds just measured by a broad kind of corporate bond index. And for this period of time that we looked at for this, there was a high degree of correlation. So the darker the color of red, the higher the degree of correlation. And so we can see that right here, well, not perfect correlation. There's a moderate degree of correlation between stocks and bonds over the period of time in question. And so if one's portfolio was exclusively comprised of stocks and bonds, you would have seen things moving fairly in close kind of alignment directionally. They wouldn't have
Yeah.
gone up as much or gone down as much, but directionally they would have been moving in the same direction, largely speaking.
Okay, and then this is a another correlation matrix where we've added another asset class. You want to walk us through this one?
Yeah, so for this one, we threw in gold, and as you can see, gold is that much lighter tone of red, almost like a soft pink right here, and that correlation is weak to none. And so by having some of this in the portfolio, you actually give yourself a little bit better diversification. If this had been a year like 2022, and if you had some money in stocks, some money in bonds, some money in gold, the stocks would have fallen precipitously. The bonds would have fallen precipitously. The gold would have preserved its value over that time. It wouldn't have necessarily gone up, but it would have preserved your value. So having some of that in a portfolio in a year like 2022 would have been beneficial.
So it's not necessarily that the metal was meant to outperform; it was meant to more behave differently.
Correct.
And then not return and enhancement rather, but risk smoothing. Right.
Exactly.
So I love that. And I think this is a really important kind of concept as we talk about the role of precious metals in a portfolio. They can add a significant amount of kind of non-correlated assets, which can create additional diversification, risk smoothing, and create a better diversified allocation in your portfolio. So, all right, Scott, we just got a couple minutes left here. Obviously, one thing that we need to appreciate is nuance, and we get a lot of people that are like all in on precious metals as if they are somehow going to be the ultimate protection during periods of kind of an economic collapse, if that's the concern. Other people kind of rule them out as useless, and I think the nuance there we've tried to unpack a little bit more today. But why do you feel like the conversation is so polarized?
It's a great question. I think for a lot of those factors that we talked about earlier, the global conflict, the sovereign debt crisis, all that stuff, and depending on kind of what side someone is on those issues, they may align or disalign with these metals on the back of it. So I think, like a lot of things in our society, they're polarized today. I think unfortunately metals have kind of become part and parcel with that. And then I think similar to other polarizing things, there doesn't tend to be a lot of nuance where it's either this or that, and there's often more nuance and complication. And so it is with metals. There's a lot of nuance with those. On the one hand, they can serve as a good hedge. They at times can help in terms of inflation protection. When economies are growing rapidly, some of these inputs for our economy can really do extremely well. Flip side of that, metals in and of themselves are idle assets. Metals don't pay dividends. Metals aren't coming up with creative, cool new things that generate value. It's a very stagnant thing. If you invest in Home Depot, they're growing their dividend on a regular basis. They're innovating. You buy Amazon, and they're branching out and forming new business. And as an owner of that, you're participating in that growth. There's nothing. Steel doesn't do that. Copper doesn't do that. Gold doesn't do that. So they're not good ways to capitalize on innovation and that type of economic growth. But they can play a role as a non-correlated asset, as a historical store of value, and at times a flight to safety asset. When things get chaotic, sometimes these will go up in value, particularly things like gold. So I think there is a lot of nuance to consider there. But I hope people are thoughtful and cognizant that what happens in terms of these trends doesn't always continue into perpetuity. And we don't know if the trends that we've seen in metals will continue for a long period of time, or if we're nearing a peak and we're going to trough out at some point. But metals do have volatility, full stop, and people should be cognizant of that. That doesn't mean they shouldn't play a role in portfolio construction, but you want to make sure it's appropriately weighted. And in most instances, stocks and bonds are going to be kind of the meat and potatoes of one's portfolio, and then precious metals would be kind of a peripheral holding to that core portfolio.
Sounds a lot like an analogy I've heard you share, Scott. You know, the toolbox analogy. Maybe walk us through the analogy and how you kind of pack that all together with what you just explained.
Yeah, so I think of an investment portfolio like a toolbox. And if we have a toolbox, we have a finite amount of space in that toolbox. We'd love to throw every tool under the sun into that toolbox, but we are limited in space. And so in that toolbox, we put just the kind of necessary items in that toolbox. And we'll probably have some items that we kind of like, but probably can't include because they're not as important and because they're going to occupy important space. And so a hammer and a screwdriver would be indispensable in a toolbox. That's kind of the role stocks and bonds play in one's portfolio. We might look and say, hey, we've got a little bit of space in a portfolio, and in a toolbox, and I always need an Allen wrench. We can throw in some Allen wrenches. The Allen wrenches would be analogous to, precious metals. Nice to have and something that we can probably fit into our portfolio, but we want to make sure it's proportioned appropriately.
So maybe one last kind of ultimate takeaway, we wrap it all together. If you had to summarize kind of your balanced position, how should disciplined investors think about metals right now?
Yeah, so I think the way disciplined investors should think about metals is not as much focusing on what metals are going to do over the next 6 months or 12 months or 18 months. I wouldn't think about metals as a speculator would and saying, hey, is this a great entry point or exit point? I would look at it and say, from a long-term perspective, do I want metals to be a part of my portfolio for all the reasons that we've talked about? And if we like the benefit of some non-correlation, if we like the benefit of having another store of value, capitalizing on some future potential economic growth, have some of that as a long-term part of your portfolio in appropriate proportions, and we can help you kind of land on what those appropriate proportions are. But it's typically fairly small. But the main takeaway I'd have, Paul, is I wouldn't be one who'd be speculating on this or that with kind of where metals are going. I would look at it more over a long-term period of time. Is this something that should be a component of my core portfolio? And if so, in what amount should I hold it?
Boy, Scott, that is not exciting. That's boring. And like all things, when we talk about investing, that generally is kind of the case. When we talk about a well-built portfolio that's going to be an all-weather strategy that's going to help us navigate, the next 10, 20, 30 years of your retirement, it generally is less exciting than the ad you hear on the radio. It's generally a little more disciplined and a little more boring. And there's a lot of nuance that goes into the portfolio. So I think my big takeaway is not to get caught up in the emotion of the day, not to get caught up in the noise that's happening of the day, but rather to keep your eye on kind of that long-term goal, because those are generally the portfolios that weather the volatility that we experience with far more grace and forgiveness than the ones that are, we're going all in on some speculative concept. It's really exciting for a minute, but then we go for a pretty wild ride when things aren't going the way we hope. So that's probably my big takeaway for all of our clients listening today is metals are awesome as a component of a portfolio, as a tool that we would add to the toolbox. And there's certainly a reason why we would keep those a part of that toolbox, but we don't want to take out our hammers and screwdrivers and make only room in the toolbox for those Allen wrenches. There's a lot that needs to go into an appropriately constructed toolbox. So,
agree.
Awesome. Well, I think that's all the time we've got for this episode. For everyone who's joined us today, we sure appreciate you guys. We hope you find a lot of value in tuning in when we do these every month. And until next time, guys, thanks so much.
Thanks, everyone.